with China, there's also this shift towards a domestic consumption-driven story. Is that happening?
So, yes and no. And one of the things that we're very focused on at JP Morgan is this sort of this argument that we're all having the wrong conversation regarding Chinese consumption. And the argument there is we've seen very clear steps from Chinese economic work forums to National Party Congress meetings, significantly increasing the prioritization of consumption. But if you look at the policy steps that have been taken post the verbiage, it's been increase of $300 billion in vouchers for consumer goods and washing machines and things of that nature. It's been an increase of the basic pension by 10%. It's been very focused on the consumption of goods. The punchline there, though, Haibin Zhu, who's our chief China economist, has done some really excellent work on this. Chinese consumption of goods is actually roughly in line with global averages. Where the real opportunity is actually in the services space. And that's not something that's been core to the conversation from the U.S. or Chinese governments, from most investors. It absolutely will be from JP Morgan moving forward, because that's where we see the opportunity.
So what you're basically saying is their fiscal hose is sort of roughly aimed in the general direction of consumption, right? But it's been more focused on incentivizing people to buy stuff, cash for clunkers, toaster ovens, air fryers, whatever. They need to refocus that more sharply on services. And the point I want to get to here is, I mean, services, it makes sense to me, right? Because it can have a multiplier effect in terms of employment as well, much more so than manufacturing.
Correct.
Right?
And that's, so there's two benefits to the broader Chinese economy. One is a broadening of economic growth in ways that are relatively tariff immune, because it would be services produced onshore for onshore consumption. But then the other element is, if you look at the type of graduates and the type of worker that you need to create jobs for social stability and economic growth, it's people with 1 or 2 graduate degrees. And so the ability to expand financial services, legal services, tourism, and then into insurance and things like that is very, very significant, and it benefits the overall macroeconomic view in multiple ways.
Yeah, and this sort of works a lot better as well in terms of aligning skills to jobs available,
Absolutely.
right? Because, I mean, folks have been talking about, look, it's not that there are not enough jobs in China, right, for the, whatever, 10, 11 million graduates that come out of their colleges every year. It's not the kinds of jobs that they would want. If you got a physics degree, you're not going to want to work on a road crew or be making Nikes, right? What about the new opportunities being thrown up by this AI explosion in China right now? Those are probably more the kinds of jobs that they would want.
So the AI conversation in China, as well as many economies that are facing labor shortages on a multiple-year view, is an interesting one, because there is a balance between the productivity enhancement that you should see with artificial intelligence from a technology perspective, offsetting disturbances within the overall employment base. And you see this with technology shifts time and time again throughout economic history. There's lots of examples of that. Ultimately, using this for productivity enhancement across the broader services sector everywhere will be absolutely critical. But we really need to lean into that in economies like Japan, Korea, China, where you are seeing that reduction in the size of the labor force.
What's holding policymakers back from doing that, though?
It's harder to implement. It's much easier to give a voucher to replace your washing machine than it is to restructure some of these services industries. The one thing I would highlight, though, is that so the fundamental question is there demand for these services, or do you have to create demand out of thin air? Particularly in the financial services space, if you look at the explosion of wealth management products that occurred in China over the course of the past 10 years, which didn't end well from a structural stability perspective, demand is absolutely there. Then it's a question of creating the regulatory environment that allows for the creation of these products in a safe, secure, stable way.
Yeah, gotcha.
So if I was to invest in China, would it be focused more on the tech sector, or would you go for something a little bit more, more traditional, like the banks, or what would it be?
So we see very significant opportunities for multi-year outperformance in a number of services sectors, inclusive of financial services, inclusive of insurance in particular. It will be broader than that over time. It's a little bit less clear from a tourism and leisure perspective who the ultimate winners will be, but we do see opportunities in that space as well. We're doing a lot of work right now to try to understand the scaffolding that will have to be created to pivot the broad, it's a massive economy, to pivot this gigantic economy economy towards a more services orientation. But particularly from a 5 to 10 year view, we do see the opportunity for very, very significant sort of multiple times outperformance over time.
What about the big new opportunity? That is this explosion of AI in China, right, post DeepSeek. And, one of the things that folks have been talking about is it's probably going to follow along the same model as what happened with EVs, right? It's like, okay, state credit, it's going to go to all these startups from provincial governments, et cetera. And then there's going to be an explosion of companies. Most of them are going to die. Out of the ashes, we'll get a handful of, I don't know, 5, 6, half a dozen winners or so, as we saw with BYD and in EVs. The funding, though, I think is going to be interesting because, as you probably well know, you're more a public markets guy, but private markets have been, I don't think it'd be a stretch to say there's been a bit of a drought in China, right? So with this EV explosion, I think the government is going to have to step in with its money, but the priorities are going to be different from, let's say, private money, right? If the government's going to go, okay, startup, you want this kind of money, well, how many jobs are you going to create?
Right.
Where are those jobs going to be? Which provinces? So how are you thinking about this?
It's a great sort of conceptual framework to think about. And the other element that I would put into the conversation is government money generally tends to come in at a differential stage of development. DeepSeek wasn't developed with government money. But if we look at the impact of government funding on many industries in China, some of your viewers may remember I was a telecom analyst very many years ago in my youth.
Yeah.
We saw this there as well, where you saw significant government funding come in to gold plate telecommunications networks, and then the policy goal shifted to cheap and ubiquitous wireless data to accelerate the development of the internet companies. And you saw the Chinese telecom companies trade from 13 times EV/EBITDA to 1 times EV/EBITDA. They became the cheapest telcos in the world because the policy priority of the government shifted to the next thing. And so absolutely critical to investing in China from our perspective is understanding where are you in the policy environment and what is the next priority to spur economic development for the broader Chinese economy. Understanding those shifts is absolutely critical to understanding where in the cycle should you be investing in this particular industry.
Where are we in China's AI cycle now, though, post DeepSeek?
So not just China, but on a regional basis as well. We've talked for a long time now about this sort of this 3-stage development cycle. And it's really modeled after the mobile internet development cycle that we saw in China. Alex Yao, who's our chief China internet analyst, has developed this idea. The first stage is hardware, so it's data centers, chips, et cetera. The second stage is productivity enhancing tools from legacy companies. And then the third stage are brand new companies that have never existed before that are providing greenfield solutions in a new and differential way.
Is China at that third stage now?
No one really is yet from our perspective. Okay. We're just entering the stage 2 environment. The interesting thing to watch will be a shift in share price outperformance from chips, data centers, et cetera, power grids, to these enablers, and then the massive disruption that you see in stage 3, because these are greenfield operations that have nothing to disruptive themselves.
Would it be fair to say that most of the AI enabling in China right now is focused on manufacturing, on the robotics, et cetera?
I think it's industrial automation. You are seeing productivity enhancements across the services space as well, and DeepSeek leveraging that model into a services environment, into equity research as an example, is something that's really going to be really important.